The management of activities is what activity-based management is all about, with the goal to improve the value received by the customer and also to increase the profit achieved by the company in providing this value. So this is a whole new way of looking at management. Management now can pinpoint avenues for improving operations, reducing costs, or increasing values to customers. Activities-based management improves management's focus on the firm's critical success factors and enhances the firm's competitive advantage. Now, when we take a look at activity-based costing, we looked at the fact that some activities were value-added, some are non-value-added. We take that idea now and we expand it. This is an extension of activity-based costing from a product costing system to a management function that focuses on reducing the costs and improving the processes and the decision-making. So now the focus is on activities, and we make a distinction between value-added and non-value-added. The definition of a value-added activity increases the value of the product or services to the customers. That is, from the customer's perspective. If I were to eliminate this activity, would the customer perceive a decrease in the quality of the product or service that I am providing them? If the answer is yes, then that is a value-added activity. A high value-added activity increases significantly the value of the product or service. A low-value activity does not contribute anything to satisfying customer needs. And so therefore, if we're looking at a manufacturing company and we're looking at the activities, you can see that some of the value added would be the design of the product, the amount I spend on machining services, on assembly, on painting. If I was to reduce any of these major activities, there quite well would be a perceived decrease in the quality of the product or the service. If it's a service company, hospital, performing surgery obviously is a value added. If it's a law firm, performing legal research is value added. If it's a delivery company, then delivery of packages would be considered a value added activity. Low value added activities need to be identified, and once they're identified, because they have no increase in our competitiveness and profitability. There are activities that we perform, activities consume resources, but you see the consumption of these resources by the activities don't add value to the product. So we could look at eliminating them or reducing them. And as it says here, that is a never-ending task. So activity-based management is all about the improving efficiency and effectiveness by analyzing and costing activities. Before, we never had the ability to cost. We never focused on activities. We only focused on costing the product or the service, and we used job costing or process costing. Now, our whole perception has changed, and we're analyzing all the activities, and because we're analyzing, we can now cost them. We can look at an activity and say, okay, what's the direct material cost to that activity? What's the direct labor cost to that activity? Okay, what's the overhead cost? All right. So again, activity-based costing, or ABC, focuses better costing of products and services. Resources are traced to activities to facilitate costing of products or services. Another way to look at that is that activities consume resources and products and services consume activities. Now that's ABC. ABM focuses on improving the efficiency and the effectiveness of these activities. If I can reduce these activities, I reduce the resources they consume and therefore would be more profitable. Resources are traced to those activities, and we look at evaluating whether that activity is value added or non-value added. So how do we go about doing that? Well, we look at the major activities first. Identify the resources used by each activity. Remember our 3 cost elements: direct material, direct labor, and all those other indirect costs, which we used to call manufacturing overhead. But now when we're focusing on activities, it's the direct material, direct labor, and indirect costs. Evaluate the performance of those activities. Identify ways to improve on the efficiency and or effectiveness. Remember, efficiency was to achieve the same results with less inputs. Effectiveness is to get more output with the same input. In short, define activities that you manage. Identify drivers and activity measures. What drives that activity? Develop the performance measurements and manage the process and the work, not the costs. If you can reduce the number of times an activity is performed, you will be reducing the costs. Now, this has also led to not only looking inside the company to be more efficient, but also outside. And a whole new thing today is customer profitability analysis. It is recognized that the resources we have in our company are there to satisfy the customer. But the customer also is consuming our resources. So we're looking at the resources consumed by our customer and recognizing that not all customers are consuming our resources to the same amount. Some are consuming more. So customer profitability analysis is the reporting and analysis of revenue earned from each customer and costs incurred in satisfying that customer and earning that revenue. An analysis of customer differences in revenues and costs can provide a company with insight into why these differences exist and the effect they will have on operating profit. Company must realize that each dollar of revenue does not contribute equally to income. Okay, the revenue we earn from our customer. Differences in the characteristics of relationships between the company and its customers can account for dramatic discrepancies in customer profitability. There can be revenue differences. Why? Because we're given discounts. There can be differences in the cost. Why? Because some customers might be further away than other customers. There can be difference in distribution channels with the customers and the amount of service level used. Some customers can be very demanding. And if they're demanding, they're taking our time, consuming our resources. So the key feature of customer profitability analysis is that it follows through the whole entire value chain. You look at all 6 functions. It focuses on the multiple transactions that we have with a customer. It emphasizes that multi-products that the customer produces or purchases, It can separate costs so that they are customer specific and aggregated at whatever level we would desire. So other factors though, we just don't want to reduce or eliminate customers, we want to retain them. But we want to also promote profitability and long-term sales growth, all right? So we have to learn from our customers. As companies realize the potential benefits of measuring customer profitability, many opportunities will wake up. Many opportunities will appear. So now this concludes the activity-based costing, activity-based management approach. I think you can see that there's been a major change in the focus of managers. We have looked at costs, managing costs before. Now we're looking at managing activities. We do that in the product costing area in activity-based costing, but we also do it in other areas, and it extends out to our customers. So this whole way of managing activities